Hi, and welcome to Russell's Market Week in Review for Thursday, June 11th. My name is Rudy Samantha. I'm the Global Co-Head of Fixed Income at Russell Investments. This week, I'd like to discuss three topics: the U.S. rates markets, given recent labor data, credit markets, and developments in emerging markets as geopolitical risks have continued to unfold. First, let's turn to rates markets, which today is really more about labor and inflation. The U.S. labor market continues to show resilience. The May unemployment rate held steady at 4.3%, with 172,000 jobs added during the month. Leisure and hospitality once again led the way in hiring, adding 70,000 jobs, potentially reflecting a temporary boost, though, from major events such as the World Cup. More encouragingly, cyclical sectors are beginning to recover after a prolonged period of weakness. Construction and manufacturing added 17,000 and 7,000 jobs, respectively, suggesting improving momentum in some of the more sensitive areas of the economy. On inflation, core PCE moderated to an annualized rate of 3.4% in May. The fading impact of earlier tariff related price increases has helped keep inflation more muted. However, we remain mindful of potential energy related inflation pressures. Historically, the indirect effects of price shocks from oil, for example, can take several months or even years to fully filter through the economy, suggesting caution is still warranted. Against this backdrop, markets have shifted from pricing rate cuts earlier in the year to pricing the possibility of additional tightening. Our base case remains a prolonged pause from the Federal Reserve. While current inflation data is relatively benign, ongoing uncertainty around energy prices and growth does not yet provide a compelling case for rate cuts. One notable development has been the greater adjustment to short term rates relative to long term rates. The 2s Treasury curve has flattened from roughly 70 basis points at the start of the year to around 40 basis points today, driven largely by higher 2-year yields. Looking ahead, this flattening warrants attention, as weaker growth expectations could eventually reintroduce steepening pressure further out in the curve. Next, turning to asset markets, I'd be remiss if I didn't mention the broader wave of mega IPOs, with SpaceX listing on Friday and OpenAI filing confidentially this week. While large IPOs do create near term volatility, a key watch point is how and when these companies enter major benchmarks and what that means for passive flows and index concentration. Specifically on credit, SpaceX, while not yet officially rated by credit agencies, has reported publicly on securing an investment grade credit rating and securing a bridge loan to restructure $20 billion of outstanding debt, which makes the company's fundamentals more in line with a strong rising star. More broadly, credit fundamentals have remained supportive. Investment grade and high yield spreads have held at levels close to prior month end, around 75 and 265 basis points, respectively. And importantly, all in yields remain very attractive, with investment grade yields near 5.5% and high yield yields around 7.2%. These elevated yield levels continue to support demand from both the institutional and the retail channels, particularly given low default rates and relatively modest corporate leverage. One area we are monitoring closely, however, is the potential impact of artificial intelligence on software business models and the impact that has on credit markets. At present, this risk appears concentrated more within leveraged software issuers, where roughly 30% of U.S. software leveraged loans are trading at spreads consistent with implied triple C rated bonds on the high yield side. However, this possibility that there will be broader spillover from public credit markets into public credit markets does remain an important watch point. Within high yield, lower quality credits have underperformed. Triple C rated bonds have actually widened in their spread by 56 basis points during the month, while double B and single B rated bonds tightened by 9 and 6 basis points respectively. Finally, issuance trends are worth noting. In May marked the first month since September of last year without any investment grade issuance from hyperscaler technology companies. Even so, strong demand and attractive yield levels continue to provide solid technical support for both investment grade and, to a lesser extent, high yield markets. Finally, let's turn to emerging markets. The recent rise in oil prices has created a clear divergence across the emerging market universe, with energy exporters benefiting and energy importers, of course, being more challenged. Looking beyond oil, however, the broader commodity backdrop has been constructive for a much broader set of emerging countries from since early 2025. Combined with improved fiscal discipline and continued commitment to IMF and other stabilization programs, this has strengthened the outlook for a number of EM economies. Importantly, both realized and survey based inflation measures suggest that the pass through from higher energy prices has been more muted than previous episodes, a recent example being the Russian invasion of Ukraine. Alternative inflation indicators also show a continued moderation of year on year inflation across many emerging markets relative to the developed market region. As a result, several emerging economies now appear constructively well positioned for policy normalization, with steeper local yield curves and stronger growth in inflation dynamics. At Russell, we continue to find selective opportunities in emerging market quasi sovereign credit and view the asset class as an attractive long term component within diversified fixed income portfolios. That's all I had for this week's Market Week in Review. Thank you for watching, and we'll see you next week.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.